Hi guys, Clint Taylor here from the Property Investor Centre, and welcome along to this very first episode of a brand new weekly video series we're doing called Q&A Time. It's where you get to send in all of your property investment questions and we'll come back to you with the answers in a weekly video. So let's get started. The first question we have is from Julian. He asks, with the current property boom periods we have seen over the last 2 or 3 years tapering off, do you see greater opportunities for first-time or new investors in both the long-term buy and hold and the trading spaces? If so, how do we best approach a changing market to make the most of the opportunities? To answer your question, Julian, absolutely. Different areas of the country at the moment, we've got some quite different situations going on with the property market. So in some of the areas that we've had really high growth over the last few years, you know, your Aucklands and Christchurch and certain places like that, some of your main centres, things are starting to soften a little bit, and we're going from that seller's market and we're starting to make that transition over to more of a buyer's market. So there's less buyer competition. Vendors' price expectations are dropping down a little bit. But in other areas of the country, in some of the smaller centres and some of the provinces, the market is still very, very hot. So where we are here in the Hawke's Bay and Napier, the market is still pretty hot. And there's been some really good sales and prices are certainly, still on the move upwards. However, when we are, looking at the market, we really need to always pay attention to doing our homework and really understanding the market that we're currently working in. If you're in Auckland at the moment and you're looking at that market, you want to be a little bit careful. It's probably reached its peak and it's starting to taper off, and it's well and truly changing into a buyer's market. There's certainly opportunities that open up due to that. For a start, lots less buyer competition, so it makes us far easier to be able to secure a property, and vendors' expectations are coming down in price. So that it's certainly becoming our time to shine as investors to a certain degree, because we're able to get in there and put some really good deals together. Some of the vendors will start to get a little bit more motivated. So in the past, if they have needed to or really wanted to sell, maybe quickly, it's not been a problem for them. They put the property on the market, within a week or two it's sold and they get really good money. Once the market starts to turn around and start to taper off a bit, that's not the case. If they want a quick sale, a lot of the buyers have sort of gone. There's not as many buyers interested. The only way that they can get a quick sale is to lower their expectation and entertain prices at lower levels. So there's certainly big opportunity, but understand your market that you're in. Investing in the Waikato or in Auckland at the moment is different to investing down here in the Hawke's Bay or down in the South Island and in Southland, for example. So understand your market, do your homework, and know what's going on in the market that you're looking at. If this is your first time watching one of our videos, please consider subscribing for more great property investment content. So just subscribe down below. And the next question, John asks, do you think it's more sensible for me to buy a house or apartment in Auckland as a first investment? I already own an apartment in Auckland, freehold with no mortgage, and I won't need a mortgage to buy the next one. Also, should I look for a house to buy on a bigger section so I can subdivide the land in the future? Now, John, to answer your question, you've obviously already got experience in the apartment market in Auckland, having already owning an apartment there at the moment. Whilst I'm not a massive fan of investing in apartments, apartments can be quite easy, quite an easy investment. You obviously don't have a lot of exterior maintenance problems and things like that. As long as you're investing into a fairly new building, then you don't have too many ongoing costs for the first few years. Obviously, apartments, you do get capital gain, but often not as much as what you do with a property where you own a chunk of land with it. So that's one thing to look out for. One negative with apartments at the moment in Auckland is you want to be very careful that we don't end up with a situation where there's an oversupply of apartments in a softening market. So there's lots of apartments being built at the moment. They've been sold off the plan. And once those buildings have been finished, lots of the people that bought them off the plan start putting them back on the market. There will be potentially an oversupply of apartments on the market, and you might see apartment values start to fall. So that's just something to look out for. I always like investing in properties where you actually own a chunk of freehold land with them as well, as you've suggested in your question. So certainly buying a property where there is a larger chunk of land where you have the option of subdividing it down the track, I mean, that's obviously a very smart move. You don't have to do it straight away, but it gives you another little strategy or option down the track when land becomes even more valuable, as you can carve a piece of that land off, either build another property on it and hold it or sell it, or just sell off that section and have another stream of income from that investment. The next question, Maylene asks, with the new bright line capital gains tax rules, can you list a property for sale prior to your 2 years of ownership? And as long as settlement occurs after your 2-year date of buying, are you then subject to capital gains tax? And on from that, can you therefore receive a deposit prior to settlement on unconditional with no implications for capital gains tax prior to your 2 years of ownership? Right, Maylene, to answer your question now. So it's a very simple answer really, and it's probably not what you want to hear, but it all comes down to when you sign, the date that you sign that sale and purchase agreement. So if you sign that sale and purchase agreement at a date that's prior to 2 years of ownership, that becomes the trigger for the bright line capital gains tax. If you sign up that sale and purchase agreement after the 2 years of owning the property, then that doesn't trigger the bright line capital gains tax ruling. So yeah, it comes down to the date that you sign the sale and purchase agreement. And the next question, Lena asks, where are the hot spots at the moment for investments, and do we still need 40% deposit? Hi Lena, to answer your questions, yes, the 60% LVR policy is still in play currently. So as property investors, we do need to put in a 40% deposit, either from cash or from equity. However, there are a couple, 2 or 3 non-bank or second tier lenders around that are doing a lot of business with investors at the moment, and they are still lending up to 80% LVR. These lenders aren't governed by the Reserve Bank 60% LVR ruling. So if you've got a broker, talk to your broker about who those lenders are, or send me an email and I'm more than happy to fill in the blanks and talk to you about who those lenders might be. The cost of the loan is a little bit more, the interest rates are a little bit higher than the Main Street banks, but if you can get into a deal with 80% lending, whereas you wouldn't be able to buy something with 60%, well then it's quite often worthwhile. Okay, your other question regarding hotspots currently for property investment. Well, the way that we tend to invest, we're looking for the positive cash flow and generating a passive income out of that positive cash flow. So it's more about, we cast our net fairly wide across the country, and as long as the location or the area meets our criteria, is not too small, has a good sized population base, and a broad range of industry and employment available, and therefore not heavily reliant on just one industry or one employer, well then that would meet our criteria for location. And it's more about identifying the opportunities or putting together the deals where we're able to get good strong cash flow and a higher than normal yield out of a property, so that we can get that passive income and that positive cash flow. So it's not so much about the areas that are going to pop in value next. We're looking to invest for cash flow, and then over time the capital gain looks after itself. So yeah, once again, I'm happy to talk to you if you'd like to talk about some of those areas that we're looking at the moment. But they're fairly broad, anywhere centre of the island. We're doing quite a few good high cash flow deals here in the Hawke's Bay at the moment, as we are also down in Dunedin and places like that. So yeah, fairly broad across the country, but we're more focusing on the opportunity to find a deal or put together a deal where we can get a higher than normal yield compared to your average property. So it's more about the deal more so than the location, as long as the location meets our investment criteria, of course. And the next question, Bobby asks, "Hi, I have a rental property here in Christchurch. The rent is doing well as it is a 6-bedroom property rented by the room. But I'm planning to sell it because I'm scared that I'm going to lose tenants. Is it time to sell? And is a holiday home potentially a better investment?" Righto, Bobby, just want to answer your question for you. I've had a little bit of experience in the room-by-room market. I don't particularly like it. Often, as you know, you can get higher than normal rents for a property that you rent out room by room, but often they're really, really hard to manage and hard to keep that occupancy there and keep that rental income consistent high throughout the year. As opposed to selling it and looking at investing in a holiday type property, often the rental income from a holiday home type investment could be a lot more sporadic than what you would get in a property like you've got now anyway. So, I much prefer to purchase properties, multi-unit properties, so a block of 3 or 4 or 5 or 6 units, where they're completely separate tenancies, and you can rent each of those units out separately. Okay, so they're a lot easier to manage, they're a lot easier to keep the occupancy nice and high throughout the year. So I would be looking at getting into something like that if you wanted to sell what you've got now and reinvest in something else rather than a holiday property. But it all comes down to your own situation. If you're looking to have a holiday property that you're going to use yourself, and the investment side of it is very secondary, well, that's a different situation. But yeah, as for the rent room by room stuff, I think it's a little bit overrated. I'd much prefer to have a small block of units that I can rent out completely separately from each other, and I find that we get really good high yields that way, and they're far easier to manage as well. So yeah, there you go. Hope that's helped you out. Thanks for watching this video, and I hope you've gained some value out of it. If you've got a question for us, feel free to ask it in the comments down below, and we'll include it into next week's video. If you'd like to learn more about property investment, feel free to jump on one of our free property investment training webinars that we're currently running, and we'll put a registration link in the description down below. Also, please consider subscribing to this YouTube channel for more great property investment content coming up. See you next week.